Have you ever wondered what the economic implications of taking bank loans in Nepal might be? Let's delve into this topic together. Bank loans are a vital cog in the economic wheel, not only in Nepal but globally. They serve as a bridge, linking those who have capital to those who need it. This function is key to understanding the economic implications of bank loans in this Himalayan nation. Firstly, bank loans provide access to capital. This is like opening a tap for financial resources to flow to both individuals and businesses. For individuals, this may mean the ability to make significant purchases such as homes or vehicles. For businesses, it's an opportunity to expand operations or invest in new projects. Secondly, by providing this access to credit, bank loans can be a catalyst for economic growth. They stimulate investment, consumption, and entrepreneurship, which can lead to employment opportunities, increased productivity, and economic development. In essence, bank loans can be a driving force that propels the Nepalese economy forward. However, the interest rates attached to these loans can be a double-edged sword. While they represent a return on investment for the lender, they also impact the borrower's ability to repay the loan. High interest rates can increase the cost of borrowing, potentially leading to financial strain for the borrower. Furthermore, while loans can provide much-needed capital, they can also lead to a debt burden. If the debt becomes unmanageable, individuals and businesses may default on their loans, leading to financial distress and potentially bankruptcy. The regulatory environment and risk management practices surrounding these loans also play a pivotal role. Banks in Nepal need to manage risks such as credit risk, interest rate risk, and liquidity risk effectively to ensure the stability of the financial system and protect depositors' funds. Finally, bank loans can influence exchange rates, inflation, and overall economic stability. Excessive credit creation can lead to inflationary pressures, while a lack of credit can constrain economic growth. As we can see, bank loans play a crucial role in Nepal's economy, providing capital and stimulating economic growth. However, they also come with risks that need to be carefully managed. While bank loans can stimulate economic growth, they also bring certain challenges. Let's start with the debt burden. Taking on a bank loan means taking on debt. If this debt becomes too great, it can lead to financial strain and potentially bankruptcy for individuals and businesses. This can hinder economic growth and lead to financial instability. Then there's the issue of risk management. Banks are taking on a substantial amount of risk when they offer loans. There's the credit risk, the risk that the borrower won't be able to repay the loan. There's the interest rate risk, the risk that interest rates will change and affect the bank's profitability. And there's the liquidity risk, the risk that the bank won't have enough cash on hand to meet its obligations. Managing these risks effectively is crucial for the stability of the financial system. And let's not forget about the regulatory environment. Regulations on lending practices, interest rates, and consumer protection can significantly influence the behavior of borrowers and lenders. While these regulations are designed to protect consumers and ensure the stability of the financial system, they can also create challenges for borrowers and limit access to credit. Therefore, while bank loans can provide much-needed capital, they can also lead to a heavy debt burden if not managed effectively. Beyond the individual borrower, bank loans also have broader implications for Nepal's economy. The availability and accessibility of credit in the form of bank loans can significantly influence the dynamics of exchange rates, inflation, and overall economic stability. Let's dive a little deeper into this. Firstly, loans can affect exchange rates. When a bank provides a loan, it essentially creates new money, which can increase the supply of the local currency and potentially lead to a depreciation of the currency's value on the foreign exchange market. This could have implications for Nepal's international trade and capital flows. Secondly, bank loans can have an impact on inflation. When banks create too much credit, it can lead to inflationary pressures. This is because the increased money supply can drive up prices if it outpaces the growth in goods and services. However, a well-managed credit system can help maintain a healthy level of inflation, supporting economic stability. Lastly, credit availability can influence economic growth. A lack of credit can constrain growth by limiting investment and consumption. On the other hand, sufficient access to credit can stimulate economic activity, fostering entrepreneurship and driving development. In conclusion, while bank loans can have both positive and negative implications, they remain an integral part of Nepal's economic landscape. Their impact extends beyond individual borrowers and businesses, shaping the broader economic environment in significant ways.